Good afternoon or good morning, everybody, and welcome to another Fintech Nexus webinar. My name is Peter Renton. I'm chairman and co-founder of Fintech Nexus. And today we have a special treat for you. We have, I would say, an all-star panel here with some of the biggest names in fintech and banking. We're going to be talking about a very hot topic, one of the hottest topics there is right now, and that is talking about reducing friction without compromising on risk and fraud prevention. So this is focusing on consumer lending. And this is an area that I know there's been huge increases in attempted and fraud attempts over the last year or two. So it isn't an easy thing, and we're going to dive deeply into that with our panel of experts. And with that, I am going to hand it off. We're going to do a quick round of introductions. Mike, why don't you go first?
Yeah, great to be here with everybody. Mike Fife. I'm responsible for Provenier's U.S. sales and consulting. We work with banks and credit unions to automate risk decisioning for all lending use cases. So glad to be here.
Okay, Rob.
Hi, everyone. Rob Seidman. I'm the Chief Product Officer of Point of Sale Lending and Buy Now Pay Later at U.S. Bank. We're the embedded finance side. We're the business division called Advance, newly launched in October. Glad to be here.
Okay. Adam?
Hey, Peter. Thank you. Good to see everyone. Adam Galler from Cross River. I run Fintech Banking at Cross River. Cross River, for those of you who don't know, we facilitate banking products for non-banks through our technology.
All right, and you're doing it for a long time. John?
Peter, I was actually perhaps the only one on this webinar who's been with you on every lending event you've run since inception.
Right. That goes back 11 years. So,
11 years, exactly.
Okay. John?
From a veteran to a first timer. Hey everyone, John Lynch. I oversee Avant's fraud management program and our originations product. For those not familiar with Avant, we offer direct-to-consumer loans, unsecured loans, and credit cards with a fully digital offering, no brick or mortar stop. And we've been digital first since day one.
Okay, I also should say a big thank you to Provenir for sponsoring this webinar and making it possible today. So let's get right into it. John, I'm going to start with you, and maybe you can just talk a little bit about Avant, what your lending products are today, and how you approach the online consumer journey.
Yeah. Like I just mentioned, we do direct-to-consumer unsecured loans and a credit card offering. Really, our approach, I would say, is transparent and frictionless. We started fully digital. We've never had a brick or mortar presence. So I would say with that, coming from a fully cloud ecosystem, we understand that the onboarding journey can be stressful. And so making it as transparent and easy to understand the steps and as little friction as possible is really the focus of everything we do.
Okay. And Rob, maybe tell us a little bit more about the lending products you have, what you're working on and the online customer journey.
Sure. We're embedded finance, so B2B2C. We integrate or work with businesses who then offer our point of sale lending product at checkout. It can come in any form. We're omni-channel, so it could be face-to-face, online. It can come in any form. Our core product is an installment loan. So like John, we are 100% digital. We don't offer anything through US Bank. It's not a direct-to-consumer play. It's true B2B2C. So you access advanced loans through a merchant who enrolls in our program and offers our consumer loan products. And similar to what John described, we're 100% digital, has to be crazy fast. We're in service of the business that has partnered with us. So that's the way we think about it. So the journey itself is twofold. One is to serve the business, and second is to serve the consumer and make sure their purchase is affordable and to their budget and to their what makes sense for them.
Mm-hmm. And what size of transactions are you typically doing? I know it's probably a pretty large range, but tell us a little bit about that.
We generally don't play in the super small buy now pay later pay in four space. We tend to be, we offer all the way down to $300 and all the way up to 25 grand, but our average is in the low thousands of dollars. It's not small ticket, generally speaking.
Right. Okay. So let's talk about fraud that's happening today, and maybe Mike, I can start with you. When you're looking at the industry and across all of the your customers and people you talk to in the industry, what product categories are having the hardest time with fraud today, and what types of fraud are we actually seeing?
What's interesting is fraud is like an omnipresent challenge that we've been facing for years, but the advent of these lower dollar transaction lending products, buy now, pay later, credit cards, these micro business loans, all of those low dollar transactions are at high risk for fraud because the lenders who are offering those have to offer frictionless customer experiences. You want to be able to get real-time approvals really quickly. And as a result, the company's ability to identify and verify the identities of these consumers or small business entities, it makes it ripe for synthetic fraud, makes it ripe for small business fraud. And so we're seeing it across certainly credit card products, certainly across buy now, pay later, but also payday and short-term lendings. All are at high risk because fake identities, synthetic identities, you have to have the right level of data orchestration up front to prevent that. And so, yeah, these low dollar type of loan products, certainly in today's world, pretty high risk.
Mm-hmm. Mm-hmm. Okay, so Adam, with you guys obviously work with a large number of consumer lenders, and when you're talking with with your lending clients, what are you seeing when it comes to fraud? What are the product categories? What type of fraud?
So I think Mike hit on many of them, but what I'll add is that I saw a stat yesterday which was pretty compelling. 51% of people report they either know someone or were a victim of fraud. That's a pretty alarming number in this country. And I would say this has really been an evolution. You think about what lending used to be like when people used to walk into a bank and they knew exactly who you were. Then we went online and things became more digital. And now we're moving towards mobile devices to present other challenges. But I think the small dollar POS, I think, presents challenges that people have had to address. And that's what we're seeing from our clients, like the fact that they have to find new ways to prevent fraud. The fraudsters just know all the same technology that we know. So they're always ahead of the cycle. So all the tools that we thought were going to help, I'll give you an example. When we first were getting into POS and a lot of the more creative lenders, to your point earlier, trying to remove friction, came up with the idea to leverage companies using what we called KBA, knowledge-based authentication. And KBA was really popular for a couple of years, and people were saying, hey, this is a way to prevent fraud. It's unique. And what we saw over time was KBA didn't do such a great job. So then we moved to things like MFA, multi-factor authentication. And so I think that what we're finding is that it is very, very hard to detect some of these synthetic fraud cases, synthetic identities, and the tools are still evolving. But I think that people are finally getting a handle on how to tackle it. But I would agree with Mike in terms of the where it's happening most often, and also some of the tools that I think are being used are still evolving.
Right. So, John, what are you seeing at Avant? What are some of the types of fraud that you're seeing most?
Yeah. So I would say the biggest fraud that we've seen probably the last 2 years is just the rise in elder abuse, and then the sophistication with which people are committing these crimes, whether it be on the originations or the transaction side. So I love digging in, like looking at deals and actually figuring out what's going on with these accounts. And a few examples we've seen of late is on the transaction side, these fraudsters are using infrastructure as code to basically spin up fake merchants. And I think we counted probably 15,000 fake merchants that these fraudsters were able to set up. And then what they do is they do Facebook targeted ads at 60 years old or plus on Facebook and say, hey, come, we'll give you an iPad for $10. You go over there, you give them your credit card, iPad never shows. These fraudsters are organized criminal gangs, so they have their own call centers. You call in, go straight to that call center. They say, we're sorry, but now they have their card info. And the next thing you know is they're doing like micro transactions on that card across their other merchant network for like the same amount as like a cup of coffee. And so they do that at such scale that, we'll see. I'm not going to get into the exact numbers, but they're probably operating at tens of millions of dollars across the industry, and just by microtransactions targeting elder abuse. And so I think that arms race that like we've positioned ourselves in now with infrastructure as code and the ability to really do direct targeted on victims is really driving an increase in elder abuse.
Wow. Okay, that's really interesting. So, Rob, I mean, what are you seeing at your end as far as types of fraud that's most prevalent right now?
A little bit harder in our use cases because our business is B2B2C.
Yep.
So generally speaking, we have 3 layers that we run through. One is a KYB. So in order for you to do business with US Bank, you have to run through bank level KYB to set up a merchant at our bank. That merchant then has to sign an agreement with our business line to offer point of sale lending. And the key thing for us is the funds are sent to the merchant; they're not sent to the consumer. So we have, a couple different layers. The key vector in B2B2C is when a merchant and a consumer get together to decide to do fraud, or they're in cahoots with one another. But because we do large ticket lending, and we have several layers of tools on the consumer side, we use. I'm sure everyone will start talking about their toolkits, but we have multiple tools, and we're constantly testing tools and data sources and data kits. So we have the merchant fraud side, the consumer fraud side, and the only way to perpetrate fraud is when you put them together, right? Where the funds are moved to a merchant, the merchant then moves the funds, either keeps them themselves or moves them in cahoots to the consumer. So it's a combination of like a synthetic fraud play along with a fake merchant that John just described, or a real merchant that engages in fraud. Those are possibilities. And so we build for those use cases. That's an example.
Right. Okay, so let's talk about sort of the how to kind of gather data in place to sort of prevent all this, and also to to try and make as frictionless of a process as possible. So maybe John, I can start with you and sort of talk about how are you kind of integrating the right data, and let's include alternative data in this in this question here. How are you doing that to make accurate decisions like across the loan life cycle?
Yeah, I think first it starts with real-time data. There is a place for maybe offline use cases, but it has to be real-time. And so really building out, I think when we started Avant, I spent the first 2 years basically onboarding different data sources. So really a data-first approach to everything. And it's really about getting a holistic picture. So metadata on where has this email been seen, where has this phone number been seen. I think beyond just the consortium data, behavioral analytics has a really strong role to play. The consortium data that even operates on a lag, behavioral analytics really connecting that data as they're interacting with your page or your mobile app, understanding those suspicious anomalies, that catches it in its spot. So having strong internal data partnerships, so you can stream data, whether it be Kafka or just direct API connections, is important. And so we couldn't operate without our strong partnership and orchestration with our internal data partners. And yeah, big data is the key. Disparate data, fast data, as much as data as you can get. That's really how we operate.
Right. Okay, so Mike, I want to turn to you and talk about this. Talk about decision intelligence, right, and mitigating losses. This is proven here has some great tools that can really help with this, and not only improve fraud prevention but maximize loan portfolio performance. maybe you can talk about some of that, including maybe some touch on the artificial intelligence piece as well.
Yeah, certainly. And John hit the nail on the head. The real answer here is getting access to lots of data in a real-time fashion. So one thing that we've done at Provenir is to try to make it as easy as possible for lenders to set up, test, and then deploy to production net new data sources. There is a host of vendors out there that are providing real-time data points on, like John said, email, the mobile device, the mobile footprint, what kind of behaviors are we seeing on this device versus other devices? So you can make a probabilistic determination as to whether or not the signals you're getting in a real-time fashion really do equal this person representing themselves truthfully, or is this perhaps fraud of some kind, synthetic identity, first-party, third-party fraud, et cetera. So from from a platform perspective, one thing we've done is we've actually begun to structure and have in place relationships with a whole host of fraud and identity providers that enables a lender to create business rules around when should I pull which data source when, so I can in real time make a determination on the likelihood of fraud. When you have that much data, that's when machine learning and AI really begin to come to the forefront, because machine learning models are uniquely suited to take in reams of data, once again, on devices, behavioral data in terms of how this device and similar devices have been used, and create that probabilistic determination that, yes, this is likely fraud, or no, it isn't. And so that's one thing we've tried to do at Provenir, is make it easy to deploy, train, and then promote to production machine learning models that actually can handle that volume of data. So I think the modern day solution to fraud is really get access to as much data as possible, then have the ability to utilize it in a real-time fashion, that's why machine learning is coming to the forefront now. It's because it can handle it.
Right, and that's one of the great things about fraud prevention is you're not limited to like a lot of data with underwriting. You have to take into account fair lending laws and all sorts of disparate impact type things, but you don't have to worry about that. When you're doing fraud prevention, you can really just suck in as much data as you possibly can. I think that's one of the great things here. Okay, let's talk about tools. What tools lenders are using to improve their fraud prevention, to mitigate losses, and maybe why don't we start? I'll start with you, Adam. Why don't you sort of give us some of the things that the companies that you're working with, what are some of the tools that they're using, or even tools that you're using?
Yeah, so we mentioned before, there's a whole bunch of different tools, and it does sort of differ by product type. Like the folks who are issuing smaller loans, perhaps the POS, BNPL folks, many of them are using some of those behavioral analytics programs that we were talking about before. I think they're also using, in some cases, MFA, mentioned that before as well, as more as being done on the mobile device. I think the mobile device continues to be a really powerful tool. I mean, if you ask 10 people in the room if they'd rather forget their wallet or their phone, they'd probably say their wallet, because I think the phone is becoming really the one device you have to leave home with. And so I think that the more you can do in that one device that makes it convenient and frictionless is really helpful. For larger loans, I think Plaid is being used by a ton of people to issue, in many cases, pre-notes. You can do those early deposits, really help weed out fraud, get bank account verifications. But to the point made earlier, it's really hard to do that for a smaller transaction being done either online, point of sale, or in store. So I think that it really just depends on the size, the dollar amount of the transaction. It will also depend on the location of the transaction. But I think overall, I think creating that digital footprint, whether it be through Plaid, whether it be through MFA, whether it be through behavioral analytics, looking at the IP address, where is the transaction being done from is super important. So all these tools together will form that digital fingerprint, that behavioral analytics you're trying to form on that customer. And I think the combination of those tools is really powerful. Those of us who were in Las Vegas a couple of weeks ago for the conference, the Fintech meetup, noticed that a very large portion of the vendors who were exhibiting there were focused on this space. And there's no shortage of tools that are out there, and competitors are out there trying to get this right. And many of them do a lot of similar things. But I think the acknowledgement is that no one tool alone will probably prevent 100% of the fraud. And so to that, what combination of tools can you provide, can you put together to create the biggest protection against fraud, but to your earlier point, removing most of the friction from the process?
Right. Okay. John, can you talk about tools and what you're using at Avant?
Yeah. Maybe also just maybe touch on data real quick. Just from my previous life, you can have as much data as you could plug in every vendor, but if you don't have a good signal to like use that data off of, what you're trying to predict, that data is meaningless. When I say a signal, like tagging data. And so I would say one of the strongest tools we have is basically our ability to do human in the loop. So we have probably like 15 different fraud investigators that we deploy across transaction and originations, and then use them to essentially tag different accounts. And that tagging of accounts is what probably creates the signal that makes any of that data meaningful. And so basically orchestrating that, an orchestration system that can ingest, I would say, human in the loop tags and then keep that loop going is where I would start with everything and probably what makes our fraud program so strong. But beyond that, it has to be a layered approach. One tool won't do it. Yeah. Yeah.
Okay. Okay, Rob, what about US Bank? I mean, you have a little bit of a different approach, going focusing on the merchant as a primary, but still need to be able to detect fraud. What tools are you using?
I think I'd echo what everyone else said. We still use an orchestration engine to ensure that where we set standards for probabilistic matching of fraud, the auth strategy you have in general is a huge deal. So it doesn't matter that it starts with the merchant. You still have to authenticate. You still have to authorize at the moment of truth of the transaction going through or not. So we deploy lots of tools. Everything that I think Mike had talked about as well, like email and mobile and multi-factor and OTP and all the other good stuff that goes along with, in addition to, all the huge data sets that we do in the modeling, right? All those.
Well, I think we
Huh?
lost Rob there for a second. Okay. Well, let's move on. So how about we haven't talked about account takeover yet. So obviously, if you're doing a consumer installment loan, account takeover is not really an issue. But if you're doing credit cards or other types of other types of products, it can be. So maybe you can John, are you seeing much in your credit card side of things as far as account takeover, and how are you sort of mitigating that?
Yeah. I would say we're definitely seeing an explosion of attempts. I would say the first thing you got to do is make sure you really understand what your controls are and operational procedures are for updating information. And then from there, making sure that you have the tools to not only take in a document if someone wants to update an address or whatever, but make sure that you have the tools to actually authenticate the source of that information. You can't trust documents unless it's maybe a PDF or what have you, but it's really making sure you understand your operational procedures and have strong oversight over those for how information gets updated. And then when it does get updated, start tracking those updates and start creating some of that signal that you can use to catch the cases that might have slipped through the cracks in the first time. So understanding operational procedures, that's where fraudsters are basically going to social engineer their way around it, and then continuously improving by tagging those cases that do go through to better model and predict how you can stop that in the future.
Right. And Adam, what about you guys? What are you seeing around account takeover?
Yeah, so this is actually a really pertinent topic. In the case of cards, as an example, I was reading a report, I think it's from 2 weeks ago, the Alloy put out that activity is still the biggest indicator of fraud, and that's why when you go into your credit card statements or every transaction you get has the ability to report it for fraud. And I think learning from that data, learning from the activities that you're seeing that are being flagged for fraud will provide you the ability to filter fraud going forward. At the same time, all the tools we mentioned before, I think are really helpful for account takeover. For account takeover specifically, behavioral analytics, looking at that borrower's activity, whether it be at the onset of the application or on an ongoing basis, will all help determine whether the transaction they're making is actually fraud. I mean, those of us who have cards know that when you make a charge or there's a transaction that seems to be out of line for a good card company, you get a text message right away. And they'll say, was this you? Are you in this location? And whether it be because you're traveling abroad, whether it be because you're buying something that is out of character with your prior purchases, all that behavioral activity and that behavioral analytics is really powerful in preventing fraud. So I think that's where the best tools on the account takeover side tend to be activity-based tools, as well as the ones we mentioned before, like IP address and password strength.
Right. Gotcha. Okay. If you're listening here and you have a question, hit the Q&A button. We are going to get to questions towards the end of the hour here. But I want to go back to you, Mike, and talk about customer management and engagement. So how are you seeing the lenders that you work with? How are they being proactive when it comes to customer management? How are they, particularly when it comes to optimizing engagement and maximizing customer value?
Well, one thing we're seeing is that customers are realizing that in order to be kind of proactive in terms of their engagement with customers and monitoring their transactions, their systems have to be plumbed to support that. So we already talked about the ability to bring in data, the ability to make a real-time decision off of that data, off of those signals in order to do a next best action. And so lesson number one is everybody's systems need to be plumbed. If it takes you weeks to be able to onboard a new data set or to ingest account data, clearly that puts you at a pretty significant disadvantage. So that's number one, the ability to get all of your data and your systems oriented in a way to respond and to be proactive in the customer management approach. Number two is you really do have to be able to bring in all of these new data sources that we're all talking about. So at the Fintech Nexus concert that Adam mentioned, certainly a lot of vendors are coming to the table with pretty advanced capabilities relative to fraud and identity prevention, relative to account takeover prevention. So you have to be able to set those up, ingest those, and test them in days, not weeks. Otherwise, you are also at a pretty competitive disadvantage and vulnerable to fraudsters. So what we're seeing companies do is get their IT systems right, move away from some legacy systems that do make it difficult to be proactive, and then they're setting up the kind of the processing of that data in a way that enables them to be proactive, which is defined by, is this transaction you? Does this seem to fit the profile of John Smith, who usually transacts here for these kind of transactions? So that enables you then to really offer a premier customer experience, limiting friction, but also being smart about preventing fraud.
Okay. So, Rob, I want to go back to you and just talk briefly, if we could, about regulatory considerations. I mean, you are, working at a top 10 bank. You're very highly regulated. How does that play into some of the things we've been talking about here?
Heavily. Maybe the short answer.
In a word.
I think we always want to do right by the customer, right? So you want to protect the customer and you want to protect the merchant, and we want to make sure, like, our job is to make sure legitimate stuff goes through and illegitimate stuff does not. Like that's the gig. So the way I look at it is, the regulatory scrutiny is, they're just guardrails, right? We build within the guardrails to ensure that we do that right in the build process when we launch products to begin with. Secondly is, we do have robust monitoring and risk tools in place, as well as audit, that constantly monitor and track how we're doing against our stated goals, right? Both to stay within the regulatory balance, as well as the business balance, right? We want to make sure that we're authorizing at the level we think we should. In our case, we have a credit adjudication process that takes place at the same time as fraud, and we have fraud tools that take place after the transaction, before the transaction. So we're in multiple places, and so I'm not sure. Like I don't look at regulatory as a separate thing. It's part of the overarching thought process around how and
Right.
when you decide to launch a product, and then when you operationalize it and build it and put it into market and monitor it for performance. You know, the whole goal is to just stay to stay out of regulatory purgatory, right? But generally speaking, if you design right, you'll be okay. And we have pretty robust tools and processes and protocols within the bank during the build process that make sure we stay there. And if for whatever reason we miss, there are uh, after implementation processes and audits that happen that allow us to remediate if we miss something, or if the rules change, which they do.
Right. Right. Okay. So we're getting quite a few questions coming in from the audience. So we'll get to those in just a second. Before we do, I want to talk about manual exceptions, right? Because we're striving for a frictionless experience, or at least the minimum friction we can have. But oftentimes there's going to be something that doesn't look right, and you want to kick it out. And John, I believe you guys do this at Avant. How are you kind of dealing with manual exceptions in the underwriting process?
Yeah, so Avant has built our entire originations platform is homegrown. So we have the technology to queue up systems, route it to agents, score those cases, and then assign priority. I think the biggest thing that like any practitioner should probably take away from manual exceptions is that the investigators working those exceptions need to be high quality. They are as important as the data scientist on your team. And so we actually have all of our investigators are sitting right next to our data scientists, because the people creating the signal and working those manual exceptions service the customer, make sure they can get through, make sure it's done properly, but also use that opportunity to get more signal and learn how we could maybe possibly avoid that exception in the future. And then get that feedback from that investigator, and then take that to your strategy team to make sure, hey, are there opportunities to reduce these exceptions in the future? So constantly learning and having a learning framework set up as you're handling manual exceptions.
Mm-hmm. Interesting. Well, that actually ties in with the first question that we have here, is how can we create a meaningful fraud signal without having lots of flagged fraud cases? So do you need to have lots of fraud before you can actually produce these meaningful signals?
No, you can definitely do a hybrid approach. You're not going to tag everything, really. So you can essentially tag what you can and then generate clustering models to basically propagate that signal to get to like boost that signal to other accounts. But we really do targeted kind of randomization, and we can, I guess, we do propagate that signal based on pseudo tagging and then automated tagging, as we call it, through clustering.
Got it. Okay. Okay. Next question here. Where do you draw the line on introducing additional friction in the process application flow? Can the group share some examples of instances where they've elected not to include additional friction to the consumer or business, i.e. the additional data you're asking for is not worth the friction?
I'm happy to jump in first. I don't have a silent answer, but I think that this is where I think the answer given before about learning from data as you go forward is important. In many cases, depending on the size of the transaction, oftentimes at the point of sale, depending on the merchant or the category, you can refine the rules so that you're not actually asking for information for, let's say, certain dollar sizes or certain categories that are lower risk. And so you can keep refining the rules until you get to a point where certain categories to certain sizes don't require additional information. But I think that takes time. I think the point is that you can't do that at day one, and you have to have iterative processes over time and machine learning to be able to do that. And so I think that that is always the goal. And we always want to have a frictionless process. We always want to have a process where consumers don't feel like they're being asked for unnecessary information. but it is necessary. At the end of the day, you know, when we get those extra requests, we should appreciate them and why they're there. It's almost like when you're going to the airport and they pull you out for that random selection at the TSA line, and you're like, why me all the time? But at the end of the day, there's a reason for it. And I think that as opposed to perhaps that process here, I think the learnings that you have in categories, the learnings that you have in different environments will help inform how you do these things going forward. So it's actually really important.
I agree.
Anyone else? Yep.
Yeah, I might add to that. I think it's contextual. I think it depends on the environment in which you're lending. I think what Adam says is exactly right. Which categories are you lending? What's the product that we're talking about? And what's the generalized experience of applying for and, you know, getting the credit product you're seeking? I think if you take all this into account, you can then assess how much friction is the consumer's willing to deal with to get the loan versus not. I also like there are other aspects to the consumer experience. I just think this is ripe for A/B testing, right? You just got to figure out within the product you're building, within the, you know, the businesses you're serving, in our case, business we're serving, you know, where's the tolerance? You know, does it affect pull through? Does it not? And then lastly, not only A/B testing, but I do think there's a risk reward trade off. Like there's just a flat out business case to be done that says, is X% drop off in pull through worth it to me if I prevent Y% in fraud and or bad auths? And so I think taking those three things into account is probably a good way to think about it.
Mm-hmm. Mm-hmm. Okay, I think this might be one for you, John. Are you creating a good signal by tagging accounts that have suffered a known fraud losses in general, or something else? Or do you mean prospective tagging of suspicious behavior that doesn't necessarily correlate to historical risk?
Yeah, so you don't want to reinforce basically your rule set. And if you only create signal off of what you escalate, then you're just reinforcing your existing rule set. So a lot of what our tagging does as well is also random account review. And so having those, almost kind of like what Rob said, it's like an A/B test in a way. So knowing what your actual true application fraud rate is by randomly reviewing accounts and having that random tagging process set up, so you aren't just reinforcing your current signal based on whatever your rules are escalating. Yep.
Okay. Okay, next question. Is there any good way to reduce the friction associated with opt-in bank data? And in parentheses, in my experience, this in particular tends to turn off a fair number of applicants. Yes, that's who wants to tackle that one?
You know, Peter, this goes back to the regulatory question in some ways.
Right.
Like, you know, you're not going to be able to get access to people's data, certainly banking data, without proper authorization. I mean, you know, that would be a minefield. And so I think that in an ideal world, maybe there's a world where you can get it synthetically. I don't know if it's possible, but I think that we have to understand that some of these things that we're asking for to prevent fraud and to reduce friction require you to give have a high level of confidence and trust in whoever you're applying to or talking to. And so I think until we get to a point where there's truly open banking and things are that easily accessible, I think you're going to have to balance, like we said, the regulatory risk and some of the, you know, potential consumer litigation with the ability to use those tools. And so I think that's going to be a continued friction going forward until we solve it, you know, industry-wide.
Yeah, I mean, Plaid has reduced the friction dramatically, right?
Yep.
In doing this, but it's still not. You still got to log in to your bank account. So
Yeah.
I
Maybe
think,
if I could
I don't know, Mike, if you want to. Oh, go ahead.
Oh, yeah, I was going to say, like, one of the things we've learned with our customer experience team is you can't just show a task to a customer and say complete it. You need to give them context of why you're asking them to do that thing, and making sure you're really transparent to the customer and explaining what this information is going to be used for and why are they being asked to do another step in the process really helps with that pull through for them completing that form field, completing that task. So if you want, I would say more data, really tell the customer why it's in their best interest to give it to you to help with the experience.
Yeah, I'll add. I think I'm going to go back to the context comment I made before. Look, if you play in super prime and you have really, really strong signals that it's not fraud, incremental information is not overly helpful to the consumer or you, right? Versus I play in BNPL, or I play in subprime, or I play in near prime. Like you probably have different set of motivations going on to have different layers of protection. So like account information, for example, can be used. So for example, if you build an experience in lending where you're asking for repayment method as part of the loan process, there's probably got to be a really good reason from your perspective as another signals, another data set, and another consent, from a regulatory standpoint, to require all that as part of a loan application process. Uh, um, in those cases, like that's a concerted effort to make one experience versus another, which is, 5 screens, 11 fields, and I'm giving you a yes, no, and you're leaving. Like that these are totally different use cases. And to me, have to be contextually, relevant. That's what I would say. So I think it's hand in hand. It goes hand in hand with like what you're really trying to accomplish for which customer group and for what end. That to me is the way to think about friction and fraud balance when you build experiences.
Yeah, it's really well put. Really well put. Okay. Next question. Any automated processes being completed with the manual exception process? I think that might be one for you again, John, when you were talking about your manual exceptions.
Yeah, I think any automated processes, I would say, apart from how you route those cases and how you assign priority to those cases, that's probably as much as you can automate the manual exception piece. Apart from making sure that that feedback gets into your data set correctly. But yeah, I would say priority of the cases and making sure you like include some automation that assigns those and routes those properly. That's the best way to make sure you can actually get through all the work.
Not to mention, by the way, the data that's presented, the organization of it to a manual reviewer. That's a way you can actually streamline and expedite their review of the information. So there's some automation in the operations of it there. But outside of that, that's probably about it.
Right. Okay, our next question, and I don't want you to answer it depends, although you can provide a little bit more detail because I can see that this is a question that begs that answer. What is the acceptable amount of fraud to tolerate in a given portfolio? And so that's one part of the question. And the other part of the question is, what is unacceptable friction? So two big topics, really.
Those are whole webinars by themselves. I'm not
right,
sure
right.
Yeah, I mean, I'll give it some thought. I'm on the B2B side as well. Maybe I'll go with the second question first on the friction side. I think that, you talk about abandonment, right, and friction. I think you don't have the same friction maybe in the larger loan space. People expect a little longer of a process. When you're talking about smaller loan sizes, point of sale, BNPL, smaller dollar, convenient loans in different locations, friction becomes even more important. And so I think that it really is abandonment. And so I think we're measuring friction from an abandonment standpoint. So when you say how much friction is too much, when it causes abandonment to get to a point where you're losing 10% of sales, I'm making up a number, 10% of sales. So I don't think of it in terms of like how much friction is too much. I think of it in terms of how much business is not facilitated from that loan process. And so I think that's probably the better way to measure it. In fact, when merchants compare which BNPL or POS providers to work with, one of the things they talk about is conversion. And conversion has different components to it. Conversion has the credit component to it, where you say how many folks will your underwriting box enable to get credit. But the second part of it is how many folks can you convert based on your process. And if we compare apples to apples, the two next to each other, how many will you convert within X number of minutes or even seconds to make sure they don't abandon the cart? And so I think those are two really important points from a friction/conversion standpoint.
Anyone want to tackle about acceptable amounts of fraud?
I would say it's all a cost function. what is the opportunity value for basically what do you expect to earn from every product you issue? And then, how what do you lose per fraud incidents, and finding that global minimum of cost where basically, yeah, I mean, it's a cost function at the end of the day, and that's really how we think about it. But also, we are highly regulated, and making sure we adhere to those regulations is a core business value. So making sure that we don't upset any regulators and that we're doing everything in good faith, and not driving a bad customer experience that can drive up complaints also comes into consideration, as much as like return on investment of a certain rule.
Mm-hmm. Yeah, and I imagine also it vary between like a, if you got someone's doing a $25,000 personal loan, you're going to have different accepted tolerances than if they're doing a, $1,000 point of sale
Absolutely.
or BNPL.
Yeah, absolutely.
Okay. Next question. Oh boy, let me see here. We've quite a few to choose from here. What fraud tools are you implementing to make sure the application in-store process is seamless for the customer? And I think maybe that one might be for you, Rob, when you're talking about dealing with point of sale type operation.
Yeah. In-store is tricky. States have different regulations for face-to-face interactions. So again, I think what I like the way Adam said it. He said it the e-com perspective, but in-store to me is the same, which is depending on what you're trying to get done at the store, right? Like the store, you're held accountable to the store to reduce their abandonment or increase their sales. That's really what you're there to do. You're in service of that end goal of the business you serve. And I think that there are two considerations. One is what is the store processes in which you are embedding yourself in, right? What allows for the interaction between the store's people and your process, how well you've created that and enabled it to take place. That's first, right? Because it's got to work for the people who are doing the job and interacting with the customer face to face. So that's first and probably most important. Second is this is where regulations do matter. It's state by state. There are some, right? And to me, it's also philosophical. Like, how are you approaching your business, right? Do you build to suit? Do you build for, hey, I'm going to put this, I'm going to put a widget on somebody else's platform. I'm going to make it so that the consumer always has to do it on their own device. Like, these are questions you have to ask yourself as you are negotiating out with the store how they really want it to work, and then how we as banks or as lenders protect ourselves in the right way and make the consumer. One of the things we don't really talk about in this fraud piece is there's the other side to it, which is consumers have to choose to use you. Let's say it's not the fraud instance, but like you still have to facilitate an interaction between the store and the consumer. That's what you're there to do. So it's one of the things we haven't talked about much is privacy. So in the consumer sense, when you do face-to-face, consumer privacy becomes another element that you have to care for.
Mm-hmm.
And in certain instances, in healthcare circumstances and others, like they live by HIPAA, they have a ton of information on you already, versus a retail, environment, like a true store environment. That's a different gig. So I just think like you're designing for the end game of the business you're serving, right? Where you are balancing out the consumer need with the store need, and the process you design, to me, has to kind of bridge the two.
Right. Okay. We got another interesting question that's just come in, which I think is something that I've been thinking about for a long time. Is do you see a product in the future where people can log in with, because you can obviously do it with Google, you can do it with Facebook and LinkedIn and other things online with different websites. But for financial websites, can you, where people can log in with to apply to any financial product online, call it like a financial passport. Imagine Plaid as a multi-credential hub app for end users. But boy, that has got to have good security if you do something like that. But it would be in an ideal world, that would be what you want, right? Anyone want to take on that?
Yeah, I mean,
Is
I
the
think, oh, sorry, go ahead.
Now, I was going from the side. Is the question, can you use your face to apply for a loan? Is that the question?
Well, it's like it's like I think it was more about can we use credentials that like specifically for financial transactions kind of thing. I mean, I think that the face is, it's certainly I think where we could go eventually, but I think this is more about, is there going to be a login with Plaid where you can just take it all the way around, any financial website, you can open up an account, you can go and it can be sort of the central kind of log in with piece. It's like we have Google right now.
It's ideal. I mean, there's all these new government forms of ID they're trying to do for airports, right? Where they uniform across the world, across the country. I think, unfortunately, you also have to get a lot of cooperation, like interoperability, things like that across financial institutions, across products would require a lot of cooperation. It would likely have to be done through a centralized entity like the government. And so, like, to me, that cooperation is probably a long way away. Obviously, it's ideal. I don't see a world where there's going to be that much cooperation where everyone will accept the same tool, unless it comes from, like I said, a centralized like government type entity.
I think we are getting close though to that, because you do have providers like the Credit Karmas of the world, Experian, where you can go sign up for credit monitoring. They start pushing you your credit reports. You can permission your own checking account data. So all of a sudden you have a closed ecosystem where lenders are then coming to you. That's the current model. This question is more about a future model where you can then take that profile, your profile, you own it, it's you, and kind of take that out to market. So I would see that coming down the pipe relatively soon. Companies are just approaching it from that other angle, which is you sign up, you enroll in these kind of credit monitoring solutions, then lenders are coming to you. So we're probably not too far away from that.
Mm-hmm.
Yeah, I mean, you can argue tokenization and open banking are paths to this model. I do think the interoperability issue is going to be a big one. If tokenization solves some of that stuff, for example, it'd be interesting. I'm not sure there's a ton of incentives for all the lenders to jump on board. Maybe there is, maybe there isn't. But
yeah, I think passkeys are getting us close to that. Your phone number is when you can tie your phone number to your actual device, and then you set a cryptographic passkey on your device that is tied to your phone number. That is your universal passport for basically authenticating yourself anywhere. And I think I think Google and Prove are getting really close there by actually linking number and then setting a passkey on your phone. So as soon as you log into your device, that basically authenticates you. So I think, yeah, we're getting really close. And
yeah,
absolutely is my answer.
Yeah, interesting. Okay, what role does tax data play, if any, in your credit and decisioning models? Anyone using tax data? No.
Tax data.
No, we have a partner that is baked into the proven year decisioning ecosystem that does leverage some degree of tax data to be a proxy for income verification. But once again, it's not individual level tax information. It's more anonymized and modeled down to the individual level. So, but not raw tax data would need to be provided. That would introduce friction. So there are some providers trying to do that, but it's not exactly the same thing.
Mm-hmm. Okay. Mike, this is another one for you. What kind of fraud prevention enhancements should consumers expect to see more of on the horizon?
I think it'll be the stuff we would expect to see for a consumer would include some of the things we just touched on, like the ability to more fully authenticate your own identity via your device, having some more of your your key information there under your control and protection. And that becomes more of a universal passport for confirming who you are, confirming not only your income, but also your credit worthiness, all with, perhaps, using biometrics from the device to confirm it is indeed you. So I would expect something like that coming about here in the near future. And I'm sure the Department of Justice will love that.
Right. Okay, so let's close with, I want to hear from each of you here, beyond what just Mike mentioned there, when you look out over the next, just say 12 to 24 months, what are the trends that you're paying closest attention to here when it comes to fraud? John, why don't I start with you?
Yeah, I would say, let's see. Elder abuse is really, our largest population in the United States is becoming more vulnerable by the day. So I think that trend, we've seen that on the transaction side. And then we've also seen that with fraudsters cherry picking identities for 60 years old plus on the origination side at significant scale as well. So that theme for me happens onboarding and transaction, then it's only going to continue.
Mm-hmm. Mm-hmm. Rob?
I'll carry on. One thing that's pretty interesting to us is business formation fraud. The new commerce platform tools are so advanced; they're very slick. You can set up businesses very quickly, and it does two things, right? On the plus side, it's exceptional for business formation for small businesses, which we love. On the downside, it's also expediting the fraud, potential of business formation, for nefarious purposes, and then setting up legit, looking artifice and, synthetic transactions pushing through. Like those types of things make us nervous, that we just need to make sure everyone's, aware of and tracking. And then on our side, where wallets go, we're tracking, just understanding the different tools within wallets, takeover, all that good stuff, identity theft, which is age old. So those are the issues we think about.
Mm-hmm. Mm-hmm. Adam?
Second, business formation. Absolutely.
Yeah.
Yeah. Maybe two things that are related to some trends going forward. I think we'll touch on what everyone has said, but I think you think about elder abuse as an example of one that ties to the economy. I think if the economy continues to spiral and people get desperate for credit, desperation will drive people to commit more fraud, and that happens within families. Right? Family fraud, elder fraud, all that will increase with the economy being where it is and people needing credit. So I think that the economy actually has a big impact on attempts at fraud. So that's one thing I would keep an eye on from a macro perspective. More micro, and I'm actually happy it wasn't said yet because I feel like I can actually say it and it had to be said on this webinar, but AI. I mean, AI will be a tool that we'll all be looking at and how we're going to use it to fight fraud. But I think the most important thing about AI, and I'll end with this, is that AI is ubiquitous, right? The same people who use it to protect consumers, the people who are committing their fraud have access to AI as well. And so who gets the better use of AI in the next 12 to 24 months? The people who are committing the fraud or the people who are preventing the fraud? And so I think being that those tools are ubiquitous, it's a race to the finish.
Right, right. Mike, you got the last word.
Yeah, we kicked off the webinar by talking about the wealth of data we need to be able to effectively identify fraud. We talked about the need to create fraud signals. So I think what I expect to see over the course of the next 2 years is all of these data providers beginning to collect and catalog deeper, richer historical data through which we can begin to utilize that to identify different types of fraud signals. So I think our sophistication, certainly the application of machine learning and AI models will increase, and we should see a commensurate increase as well in fraudsters' ability to use that. So I think what we'll see is a lot more data, a lot more utilization of it, and of course that may end up presenting even new risks that we have to keep in front of.
Right, right. Well, we'll have to leave it there. Really fascinating discussion, gentlemen. Just really thought it was lots of interesting topics discussed here. Thank you very much to John, Adam, Rob, and of course, Mike, and thank you to Proven Ear for making this possible. And of course, thank you to the listeners and the viewers for tuning in. Have a great afternoon, everybody.